Chapter 7 deals with banks and money. So very key to this course because this is a money and banking course. So it talks initially about why banks even exist. And it uses this terminology of asymmetric information. So asymmetric information is information that is not equal. And they give the example, which I think is actually a good example of, like, let's say 10 years ago, if you were looking for a used car and you didn't have all the online sites that we have now that we can look up to see if those cars were in accidents and how many owners they had and all that kind of stuff, like those Carfax reports. So like 10 years ago, we didn't have that, or 20 years ago. So there would be the used car dealer is going to sell you a car. Now they know everything about that car. They know, how it's been cared for, the maintenance of it, if it's a good deal or a bad deal, but they're not going to share that with you. So then you come in and you don't know. So, you look at it, you kick the tires, you do whatever you're going to do, and you're going to take a guess. So then what it says is in that type of environment, there's going to be an average price because you'd say, okay, if it was a great car, I'd pay this. If it's they call it, if it's a cream puff car is what they call it, or a lemon, there'd be two different price points. But since the buyer doesn't know, they're comfortable with the average because then that way they feel like, okay, well, we're going to kind of hedge our bets and go right in the middle. Well, then what happens is then the sellers of the cream puffs are not happy. They have this wonderful new car or used car and they're not getting the price they want. So then it lends itself to more and more of the lemons showing up in the market because then those people are happy. They're getting a higher price. So then the whole quality of the market goes down. So that's kind of the example of the asymmetric information. Now, granted, in today's day and age, I feel like we have so much information at our fingertips. A lot of that has kind of been changed because we do have so much information as buyers and sellers. Then the second term that they discuss is adverse selection. So adverse selection occurs when there's two parties in that transaction, again, that have different levels of information. So the one party knows kind of all the information about that car, and the other party is just guessing. So then solutions to this situation is, again, just a better flow of information. That's really what's going to help our economy and our banking industry and all of that. Okay, so that's our first section. Then it gets into it to say, okay, well, adverse selection, again, this lack of information on one side to the other side, how does that occur in financial markets? So, banks lend money. So when they're looking at a potential lender, you're applying to get a car loan or you're applying to get a credit card or a mortgage, they don't know you. Okay, yes, I'm an excellent credit report. I pay all my bills on time. I have a great job. But they don't know that. And to be honest, even the people with bad credit are probably going to say that same thing. No one's going to admit, yeah, I may not pay that loan back. So then the bank is looking at everybody and everybody's saying, hey, I'm a great risk. I promise I'll pay. So then that's that lack of information. The borrowers know their ability to pay. The banks are trying to figure that out. In the bond market, the issuers of the bonds, because again, they're the people who are borrowing the money and have to pay the interest. So they know what they're using that money for. They know if they're going to be able to repay it easily. And then people like you and I are investing in that bond market. We don't know. We can do some research, we can kind of try to figure some things out to see if that company seems like a good company, but we really don't know for sure. So again, one side has a little more information than the other. And then in the equity market, which would be stocks, selling preferred stock or common stock, again, like the board of directors and the people who are running that company know what they're going to do with that money. They know if they really feel like that they're going to take off and their stock prices are going to soar. And investors don't. Investors do ratio analysis and try to look at their past history of those companies to see what they can predict about the future, to see if they seem like good investments or bad investments. So again, it's that same thing that we just talked about, that one side has information, the other side doesn't. So ways to solve that problem is to just, increase our information collection. And like I said, in today's day and age, with our internet capabilities, we really can do so much more from that standpoint. Banks can get credit reports on people. They can, get your spending histories, what your asset purchases were in the past year. I mean, they can research all of that stuff to see if you would be a good credit risk. And then you as an investor, or the people who are investing in bonds or stocks, they too can do a ton of research, and make some ratio analysis computations, and look at the history of that company and look at their financial statements, and because all that stuff is out there publicly. And that takes us into that next thing. It talks about government required disclosures. So in order for a company to be publicly traded, to sell their stocks and sell their bonds to just general public and out there in the stock market, they have to be subjected to the Securities and Exchange Commission. So that's the SEC. And the SEC is going to look at their financial statements at the end of every year. They'll have auditors that look at them, and the auditors report back to the SEC to say that, yes, these financial statements are prepared according to generally accepted accounting principles, and that they seem free from any material mistakes. So then we as investors can use those and say, okay, well, we can look at these financial statements and know that auditors have reviewed them, and those have been returned into the Securities and Exchange Commission, and we can feel fairly confident. There's always fraud that occurs, but we can feel fairly confident that those financial statements are going to be accurate and able to be relied on. And then again, screening, what it talks about there is, not only can the bank do like a credit check on you, get your credit report, but if you are a customer, and a lot of times they do try to, obviously sell their loan products to their own customers, they can look at your banking transactions. They can look into your checking account and see, this is your paycheck, this is how much you pay in rent, this is how much you pay on your credit card bills. They have all your financial data. So, they could do, they can really look in a lot of detail to make sure that they're lending to the right people, again, assuming they're their own bank clients. Okay, then the next section talks about moral hazard. So moral hazard is when an entity takes on an excessive amount of risk because it knows somebody else is going to bear the burden. So it gives you the example of, like insurance. I'm going to jump to that one first. I'll come back to the other one now. But like insurance is a good example. If you knew, you have an expensive car, and if you had no deductible, and you knew, your insurance rates aren't going to go up, you're not even going to drive it. You'd think, well, so what if I get in an accident? It might be inconvenient for me, but somebody else is paying that bill. I feel like we sometimes do that, even like with our medical insurance a little bit. People realize, oh, hey, I'm to my deductible. I'll have all these tests done because somebody else is paying that bill. So it's kind of a little bit of human nature. Then it talks about, like, in a corporate company, that can happen a little bit, and what is called an agency problem is when the corporation is basically owned by stockholders. So people who've invested in that company, they've put their money into it, they hope that stock price goes up, they hire a great group of managers who are on salary and get benefits and all that stuff. Well, ideally, what the stockholders want is they want that stock price to go up. They want those managers to grow that company in a conservative way, but yet still grow it. They don't want it to stagnate. They want it to increase. If it increases, the stock price goes up, and that's what you want as an investor. So you wouldn't want, while you want a prudent management team, you don't want them too prudent that they're scared to even do anything. You want them to take a little bit of an aggressive step to grow and to get bigger and stronger. And then if they're worried about losing their jobs, they might not do that. They might run the business too conservatively and miss opportunities. So they call that an agency problem when the management is focused on, maybe making a conservative decision to not risk losing their jobs, where the owners of the company maybe want them to take a little bit more of a risk. And one way that can be solved is by making those people shareholders. When I worked at the oil and gas company I worked at, all of our executive management team, their annual bonuses was paid to them in shares of stock. So instead of getting cash, they got stock. So then they all of a sudden are very interested in what that stock price is doing. So then that kind of deals with that agency problem and puts that management team kind of on the same page as the stockholders. Everybody wants the stock price to go up, so everyone's going to make decisions that help that to happen. So things that we can overcome those things. So these moral hazards, I gave you the example in insurance, the example in corporate America. Things that we can do. So they talk about, like, from an insurance standpoint, you have deductibles and you adjust premiums based on their accident levels. And we all know that that's actually how it happens. For bank loans, they can do what they call restrictive debt covenants. Because then with the bank loans, what that's saying is when people consider it somebody else's money, so maybe you're thinking, yeah, I'm going to play the real estate market. I'm going to go borrow money to buy this house. I'm going to let it sit for a year, and I'm going to guess that the housing market's going to go up. I'm going to sell it, just make a, easy 20 grand. That's what you could think. Well, then what if that doesn't happen? Do you know what I mean? The housing market goes down and you're going to lose 20 grand. Well, you might just walk away from that house, and then it's the bank's loss because it wasn't your money, it was their money. So that's what they're saying with that from a lending standpoint. When it's not your hard-earned cash, when it's money you just borrowed, you might be quicker to take risks with it. So then the restrictive debt covenants could come into play with that to say, well, if you do get this loan, we're going to limit your ability to get any future borrowings. You're going to have to keep so much cash on hand. They'll put limits on that. Or with businesses, they can't pay out any dividends unless they have a certain level of income or a certain level of cash. Then banks can also ask for compensating balances when they give a loan. So they'd say, okay, I'll, to a business, I'll give you $100,000 business loan, but you have to keep $20,000 in our bank. And so that they've got a little cushion that's left in the bank, plus they can monitor kind of how you spend it if you're using that as a regular checking account. And then the board of directors, that's a way to kind of have a bridge between your stockholders and your management. So the corporate board of directors are not employees, but they are paid a fee for that. And they rotate every 3 years. So they are supposed to be more of like those impartial people that are bridging the gap between your stockholders and your management of the company, and they kind of make and govern the big decisions of the corporation. Okay, then we get into banks. So the first section talks about liquidity. So liquidity is the ability to turn assets into cash quickly. So banks obviously need to be able to do that because, if I want to go into the bank, I got paid today. If I want to go in and withdraw $1,000, they have to be able to do that for me. Give me that $1,000. That's our relationship. So they have to be able to liquidate assets quickly to be able to get that cash. Then they talk about when banks are coming together, they're bringing borrowers and lenders together. So if I'm in savers, so if I'm saving money and I'm putting money into my checking account or into my savings account, or maybe buying a CD with the bank or a money market account, then all of a sudden the bank has that money, and then they can go out and find borrowers who need the money. So then the bank kind of serves as that intermediary between the two. So that helps to reduce transaction costs and reduce search costs. So search costs are obviously, if we didn't have a bank and say I had money to save, but my neighbor down the street wanted to borrow, we'd have to find each other to know. So the banks obviously take care of that. We don't have to go out and try to find people. And then there's an economy of scale. So maybe I don't have $100,000 to save. Maybe I have $2,000 to save. But then if everybody in my neighborhood all has $2,000 to save, we could come up with that $100,000 for somebody else to maybe buy a house. You know what I mean? So that's where that economy of scales comes in, is it takes everybody at all their levels combines that money and then can make larger loans accordingly, which is also what they call block lending. And then they talk about diversification, where you are diversifying your assets. So from a bank standpoint, they're diversifying their risk by letting a variety of, there's a variety of people who are depositing money and a variety of people who are borrowing money. And that includes businesses and individuals and everything. Okay, then it gets into this simple deposit multiplier, which is kind of a computation, but you can read through that because it gives you some different, like real basic scenarios. If so-and-so deposits money and then the bank has to keep a reserve, so they say, okay, if he deposits $10,000, they need to keep $1,000 on hand, again, in case he comes in and says, hey, I want $1,000. But then they could loan out the $9,000. Then the $9,000 could maybe be loaned out to another guy who takes it to a different bank, and then that bank has to keep 10% in, but then they can loan out $8,100. So it's a way of kind of creating money and creating a flow of money through our economy. So it's kind of interesting when you read that through. And then they also give you a formula that shows that just a deposit of $10,000 could end up creating $100,000 of money if it's moved around and loaned out and going through a variety of different people. So that's kind of interesting. So kind of read through that section. Then we take that simple deposit multiplier to say, okay, that 10,000 can create all this extra funds, and we think about, well, how does that impact the banking industry? So again, the fact that they can get the deposit and then loan it out, and then they do keep some in reserves, it's creating a new money supply. So that's increasing the money supply as they're doing that. If they make changes to that, then they can start to destroy the money supply. So then it talks about what is called a bank run. And a bank run happens if we're in a bad economic time where people start to question the ability of banks and think, well, what if my bank goes under? And they give an example of like that happening I think in the United Kingdom, but where the people started to think, oh my gosh, I think this bank does not have the cash available. And then if if all the depositors go in on one day, if we all go in and say, hey, I want all of my money out, or I want most of my money out, the bank can't do that. Like I just said in that example, they only keep like 10% on reserve. So they could not possibly take all of their deposits and give them back out to the people, even though they know that they owe them. But that's called a bank run. And then that bank run, that can be very harmful to the economy, and it becomes like a self-fulfilling prophecy that then maybe that bank really will go bankrupt because everybody came to get their cash out. Or you can just have a credit crunch where there's just a general reduction of the available credit. So maybe the banking industry is starting to think, I think the economy is going down, or I see some issues in the stock market, and we're going to just reduce our lending. So if they start reducing their lending or only giving to people who are very high credit worthy individuals, then you're going to lower that supply of money, because then there's going to be less money loaned out, less money moving through the banking system. And then, that can result in the economy slowing down. So that actually can create again, it's almost another one of those self-fulfilling prophecies. Then it talks about in an economy where there's a lack of banks, if you were in an environment where you did not have a bank, so certain countries are like that, your economy can't grow without a bank that then is borrowing the money and again creating that higher money supply. It's very difficult for the economy to grow. Okay, so that is pretty much of what you need to know for that chapter. Again, read through it, you can look through those examples of that multiplier, and then work on your homework.